Welcome to Precani Trading Networks, where we make trading simple. I welcome you once again to Forex 103. Like I used to say, take your time. Learn the skill that will pay you for the rest of your life. In order to get started, you need to have one thing in mind. I am a student always. Do not compare yourself with anyone else's progress. Always keep a winning mind frame and you will do very well in this business. Upon finishing this lesson, you should know the answers to the following question: major currencies, major currency pairs, major cross-currency pairs, minor currency pairs, currency correlation, what is volatility in Forex, what is liquidity in Forex, market gap in Forex. So let's talk about major currencies. There are many official currencies that are used all over the world, but there are only a handful of currencies that are traded actively in the Forex market. What are currency pairs? Currency pairs are the national currencies from two countries coupled for trading on a foreign exchange FX marketplace. Both currencies will have exchange rates on which the trade will have its position basis. All trading within the Forex market, whether selling, buying, or trading, will take place through currency pairs. In general, the 8 most traded currencies in no specific order are the US dollars, the Canadian dollar, the euro, the British pound, the Swiss franc, the New Zealand dollar, the Australian dollar, and the Japanese yen. So you can see them here, the most widely traded currencies, right, and their nickname and the country they belong to. Then let's talk about the major currency pairs. In the forex market, you buy and sell currencies in pairs. The exchange rates will fluctuate based on which currency is stronger. These are the most frequently traded currency pairs and are considered the majors due to having the most transactions. These majors have the most liquidity. So you can see how they are always paired in the forex market. We have the Euro USD, we have the USD JPY, we have the GBP USD, we have the USD CHF, we have the USD CAD, we have AUD USD, and we have the NZD USD. All these are the most and the majors when it comes to forex trading. There are other major pairs that have been added, alright, but these are the most traded. These are the ones with the most liquidity. Okay, yeah. So let's talk about the major cross-currency pairs and minor. These are currencies that does not contain the US dollar, some of which correlate with one another and some don't. With the availability of these currencies, a trader can always find opportunities to trade, as this would also structure his trading time and discipline according to his own schedule and trading sessions. We have the euro, the JPY, the GBP, the CAD, and the USD. So you can see that apart from the dollars, these are other currency pairs that you can still trade. So these pairs are not paired with the dollars, alright? You can see the euro pairs, you can see the JPY pairs, you can see the GBP pairs, the CAD, the AUD, and the NZD, alright? Now let's talk about currency correlation. A currency correlation in Forex is a positive or negative relationship between two separate currency pairs. A positive correlation means that two currency pairs move in same direction, and the negative correlation means that they move in opposite direction. The most highly correlated currency pairs are usually those with close economic ties. For example, the Euro USD and the GBP USD are often positively correlated because of the close relationship between the Euro and the British pound, including their geographic proximity and their status as two of the world's most widely held reserve currencies. Alright, so it means that currency correlation, when you say that a currency correlation is positive, it means that in this example, Euro USD and GBP USD will be having the same movement in the market, but may not be in the same volatility. Alright, yes, they may not be moving at the same pace, but they actually have the same move in the market because they are correlated. All right. In this case, you find out that the USD is the second currency, the euro is the first currency. And when you look at GBP USD, the GBP is the first currency and the USD is the second currency. Now, in Forex terms, we call it the base currency is the first currency and the quote currency is the second currency. All right. So in this example, the first example here, you're going to see that the Euro USD and the GBP USD, talking about the positive correlation. All right. In this place, USD maintained the quote side of the currency, and Euro and GBP maintain the base side of the currency. So it means that they are correlated, meaning that they are going to be moving in the same direction, but may not be in the same volatility. Same thing with Euro USD and NZD USD. But if you look at the number 3 example here, you're going to see that here USD happens to be the first currency and CHF happens to be the second currency. Do you understand? So it means, and again, if you look at USD JPY, USD here is also the base currency and JPY is the quote currency. So you can see that in this currency pair, USD maintained the first position as the base currency. So it means that whenever the dollar is strong, the dollar is going to push these two currency pairs in the same direction. All right. So I just you can go through this video again to understand what I just explained. And if you look at the negative correlation, you can see that here, for instance, Euro USD and USD CHF does not have the same base and quote position. For instance, Euro USD comes first as the base currency, and USD, came second as the quote currency. But on the other pair, you are seeing USD is first as the base currency and CHF came second as the quote currency. So the both pairs compared together does not have the same correlation. All right. Now let's get started with volatility in Forex. What is volatility? Currency volatility is characterized by frequent and rapid changes to exchange rates in the Forex market. So what I mean by this is that, let me use the Naira to explain. We can remember, there was a time when almost every week the dollar, kept on tumbling the Naira. So you notice that the Naira was maybe selling at 600 per exchange, and in less than a week or two, it has moved from 600 to 900 or 1000 or 800. That is what we know as volatility. The movement between price. All right. So you can relate that to this definition. I said it is characterized by frequent and rapid changes to exchange rate in the Forex market. Understanding Forex volatility can help you decide which currencies to trade and how. In this article, we are going to explore what Forex volatility is and how to identify it, review their high volatility currency pairs to look out for. Now, what is Forex volatility? Volatility in Forex trading is a measure of the frequency and extent of changes in a currency's value. A currency might be described as having high volatility or low volatility depending on how far its value deviates from the average. Volatility is a measure of standard deviation. More volatility means more trading risk, but also more opportunity for traders as the price moves are larger. Now let's talk about gap. What is a market gap? Gaps in Forex changes compared to other markets. However, price gaps can occur in Forex if an interest rate announcement or other high impact news announcement comes out against expectation. Gaps can occur at the week's opening on Sunday afternoon in the US, which is around 10 p.m. Nigerian time. If there is a news announcement over the weekend, then overall gaps in Forex are usually less than a 0.5% of a currency's value. So gap refers to areas on a chart where the price of a currency or stocks moves sharply up or down with little or no trading in between. As you can see from the picture, this is what we refer as market gap. You're going to always see this mostly every month as a Forex trader. Let's talk about the importance of market gap to a trader. A trader can potentially exploit the gap and make a profit. In this article, we're going to look at the 4 different types of gaps you will come across in your career as a trader. Types of market gap. Number 1, we have the breakaway market gap. A breakaway gap is a term used in technical analysis which identifies a strong price movement through support or resistance. Breakaway gaps are often seen early in a trend when the market moves out of a trading range or following a trend reversal. So you can see from this picture what a breakaway gap looks like. Alright? Then we'll talk about the exhaustion gap. These gaps occur near the end of a price pattern and signal a price attempt to hit new highs or lows. Alright? So this is what we refer to as the exhaustion gap. They are those that happens near the end of a good up or down trend. They are often the first signal of the end of that move. They are identified by high volume and are large price differences between the previous day's close and the new opening price. Then we'll talk about the common gap. Alright, these gaps don't get placed in a price pattern. They simply represent an area where the price has gapped. A common gap is a price gap found on a price chart for an asset. These occasional gaps are brought about by normal market forces and, as the name implies, are very common. They are represented graphically by a non-linear jump or drop from one point on the chart to the other. Then finally we'll talk about the continuation gap. Continuation gaps occur in the middle of a price pattern and signal a rush of buyers or sellers who share a common belief in the underlying stock's future direction. Alright, so usually in Forex trading, there's what we call gap fill or gap correction. After a market gap, there is always a fill up. The operating window for gaps can be perilously short as the market tends to fill the gaps in quickly. So when a gap does get filled, the price has moved back to the original pre-gap level. Overly optimistic or pessimistic views, referred to as irrational exuberance, can invite a gap fill as prices are moving up or down quickly. So when gaps get filled within the same trading day on which they occur, this is referred to as fading. Due to the low liquidity and volatility of gaps, playing them can be risky, especially in the diverse Forex market. But if properly traded, gap trading can offer opportunities for quick profit. So usually whenever there is gap in the market, alright, yes, if that currency pair economy is stable, the market will always fill up, or the gap will always fill up. Alright, so that's what we call gap fill or gap correction. Example is this you're seeing on the picture. You could see how price gapped and later price went back again to fill up that gap. Alright, congratulations, you've come to the end of Forex 103. Please ensure that you ask questions in line with the context when necessary, as I am saddled with the responsibility to answer you immediately. Remember, never to compare yourself with anyone else's progress. Take your time and you understand better. Thank you for your time.